Welcome to Market Newsroom. Here is your complete market briefing for August 7th. Oil markets are being pulled between diplomacy and renewed security fears. West Texas Intermediate crude fell more than 10% at one point this week, as traders bet that talks involving Iran, Oman, and the United States could restore shipping through the Strait of Hormuz. Reopening that narrow route could release constrained supply, so traders quickly removed part of oil's geopolitical risk premium, the extra price paid when conflict threatened supply. But the relief faded as fresh Houthi attacks hit Saudi Arabia and disputes continued over possible tolls and restrictions on ships from hostile countries. Physical traffic also remained weak, with only 6 crude tankers clearing the route outbound this week. For investors, headlines may keep overpowering ordinary supply and demand data. Secure passage would help energy consumers and inflation expectations, while another disruption could quickly lift crude and energy shares again. Alphabet plans to raise $20 to $25 billion through bonds, adding to $50 billion in bonds and $85 billion in equity sold earlier this year. A bond is money borrowed from investors and repaid with interest. The scale of this financing shows that artificial intelligence is not only a software story. Training models requires chips, data centers, cooling systems, and substantial electricity. Demand for the offering was strong, with $115 billion in orders, showing that lenders remain willing to fund the expansion. Still, the borrowing raises an important question. How long will it take AI revenue to justify the spending? Power shortages in Southeast Asia add another constraint because data centers cannot operate without reliable electricity. Investors should watch capital spending, debt growth, power availability, and whether AI products begin producing enough profit to support this infrastructure build-out. Conflict and shortages are pushing global fuel trade in unusual directions. Russia has begun importing fuel from South Korea after drone attacks damaged its refineries, where processing has fallen to its lowest level since 2002. China, meanwhile, increased crude imports by 22% in July after a historic June slump, suggesting renewed buying as prices eased. India remains highly exposed because domestic crude output fell 3% in fiscal 2026, while imports still meet 90% of demand. These gaps are benefiting American suppliers. United States diesel exports reached a record as overseas buyers search for replacement fuel. The investor lesson is that energy companies are no longer competing only on production. Refining capacity, shipping access, storage, and flexible logistics can determine who benefits when normal trade patterns break. Watch refinery disruptions, China's buying, and export volumes for the next shift. That is today's daily edition. Subscribe to Market Newsroom for market-moving news every weekday.